Good evening, everyone. Welcome. I know this is just after Nandan session, so you must be absorbing some of the information that came through Nandan. Um, Welcome, and we have an interesting panel today. Long introduction already for all of us, so I won't take much time, but it's an interesting panel from different perspectives. Saurav, Nikhil come in from API side on insurance. Suresh comes in both from the asset owner, which is an NBFC, and a distribution side. And we have Anubhav from Rupify, who works on distribution as well as API. So it's a great mix of a panel coming in from different background. My background is investing, so I'll try and see what information I can extract from you all for the benefit of the audience. So let me start with Nikhil. Nikhil, you've started Setu, and I think the whole promise, when we invested in Setu back then was West monetized through advertisements. In India, we will see companies monetizing through finance. In your definition, first and foremost is maybe for the audience, how do you see embedded finance? How would you define it? Maybe if you could touch on that.
Sure. I think there are different ways to think about embedded finance. One is obviously, it's become a favorite term for VCs to have a thesis and invest around that topic. But the simplest way to think about this is, how do we make financial services more accessible and affordable to people? Not just from the manufacturer of the financial service product. If we simply think about this, all the regulated entities which basically offer, whether it's insurance, payments, bank accounts, credit, they're all the manufacturers of financial products. Just like, in the FMCG world, we have a manufacturer, we have a supply chain, and then we have retailers, like a Kirana shop where you would go and buy product A, product B, product C. Embedded finance is something like that, where there is manufacturers, there is digital supply chain, which we all call as APIs, and then there are retailers of these financial products, which basically make it available and accessible to people in the last mile. It just so happens that all of this happens in the digital world. In the physical world, if you were going to do this, you would build warehouses, you will build your wholesaler, distributor network. But in the case of digital, you basically are building this supply chain through APIs, and then you have a set of retailers who are enabling this. Now, the question then is like, what products qualify as embedded finance products? And I think one of the things that happened in India, and because of all the infrastructure that's available, the design of India's stack has always been to promote this partnership model, right? So where you can use KYC, payments, and leveraging that infrastructure to build the second order products like insurance, credit, savings products. And I think for all of us, the best example is UPI. The fact that your manufacturer of a savings account, let's say wherever you have your money, let's say it's in a savings account with Bank X, the fact that you can link that Bank X on a third-party app and access that bank is one of the best examples of embedded finance. I would even go to argue that a payment gateway was probably the original embedded finance product because it enabled a merchant to collect payments from their customers through multiple payment methods. It could be savings, could be credit, and so on and so forth. So that would be my broad definition of what embedded finance.
No, thank you. Thank you for that, Nikhil. And no, that's interesting. Interesting in a way that, see, some of these things have always existed. There had been a distributor, there had been a bank, which was maybe underwriting, and maybe technology is a new layer. Would you say, Suresh, that typically, say if you're able to offer financial products via a non-financial channel, would you see that as an embedded finance? Or do you see that, no, it's much more than that?
I think it's one thing that we all need to keep in mind, the segment that we operate. Embedded finance has already been there decades, right? If you go to villages, they take everything in advance, they deal in commodities, right? Exchange of goods happened, underlying being the finance. But now what is happening is that in that segment, there is a culmination happening with the interventions of technology, the intervention, awareness, the payments, etc. But whether it has reached everywhere, answer is, it could be better. Right?
And can you touch upon that, particularly given that Sammoonnati works more on the rural side? Which products have you seen have taken well? And when I say product, I mean, you talk about savings, you talk about insurance, you talk about, loans. What have you seen in Bharat market? Where do you see we have actually reached an inflection point? There's a lot more adoption now. Where do you see that, things are still, we'll get there in some time?
See, one area where we see a lot of penetration is on the DBT. With the DBT coming in, people are getting money into the account. So that's the first thing. The second area where we see that a lot of the subsidies which are now going directly, so that is happening. But I think area where we see a lot of intervention required is on the insurance, because there is an aspiration to protect themselves. The second is also wealth creation. Now, there are opportunities for us to work on that. Maybe a simple thing like I can start investing with a mutual fund of 100 rupees per month, or can I get an insurance at 50 rupees per annum? So we ourselves done a product, Annadaata Suraksha Abhiyan is the product, non-contributory. For less than 100 rupees, we cover now 12 occupational hazards for the farmers. Now, the first year, they are getting that benefit, and next year they say, can I increase the limit? Can I add more members? So there is an aspiration there. But I think the key is that creating the awareness and make the affordability. Those are the two things that we see on the rural side.
Okay, interesting. And Saurav, given that, Suresh talked about insurance, you are, an insurance API provider. What kind of insurance products have you seen working well in the rural market, in the Bharat market really?
So I'll just, take a few steps back here and, for the, just to basically understand that embedded insurance, subset of embedded finance per se, is a category in my mind is going to be the most benefiting category when it comes to embedding. And the reason I'm trying to say this is because embedding will only work if it's driven by tech, number one. Number two, why I say insurance is going to benefit the most, because insurance as a category is the most misunderstood and untrusted category. So when you embed, you bring it, converge it to contextuality, right? So when contextuality is brought into the picture and supported by data, which is removing the friction of underwriting and technology and ease of use, that's where it becomes easy for consumption. So embedded insurance per se, and I'll come back to your question, Saras, in terms of what's worked really well in the rural markets, is going to be a third of the channels that's how insurance will be consumed post 2025 onwards. So every one out of 3 insurance consumption channels would be done through embedded insurance. And that's what's the estimates talking about right now. What's really worked well in the rural markets? Crop insurance has just been obviously based on parametrics. These are all, there could be a combination of private and government schemes. Not only parametric-driven crop, but parametric-driven livelihood is something that's working really well. Now, why this works well? Because, again, the consumer knows that there is a contextuality of a NatCat event that might happen. the met data comes straight back to the insurer, and the insured doesn't really need to prove whether this event had happened or not, and the claim gets settled. Now, if this friction is removed from the whole process, the category gains more trust. And that's the underlying factor which is going to ensure that this, insurance benefits out of it the most, because it's highly underpenetrated, as we know.
Got
So,
it. No, that's interesting. And on that, Anubhav, I'll come to you. Given that you work on the lending side, you work with a lot of large enterprises through which you acquire MSMEs and you help them underwrite. What I want to understand, Saurav and Nikhil also touched a little bit around, underwriting this user base and the data access and some of that. Do you face challenge given that your dependency is much more on, say, a customer like Walmart, etc., and then eventually their suppliers? Is Walmart open to sharing data with you? That's the first question. And is that, there is a lot of hype. To be honest, we'd been talking about embedded finance for maybe 2-3 years. That had been a story. Has it really worked, or is it still in that hype cycle? Is it something where, there's a lot of promise, but still we are still scratching the surface? So what had been your experience?
Sure. So I think a couple of points. I think contextualization that you mentioned and trust building that happens are key, whether it's about consumer or SMEs. And especially the platforms, Saras, that you mentioned, the large enterprise-like platforms which operate in B2B channels or supply chain, trust building happens over time, all right? So what we've seen is a few things that clearly highlight the potential of embedded finance. One is there is a constant evolution in terms of how the regulator has also started looking at this space. I still remember, I think it was 6-7 years back, Nikhil might recall, as part of iSpirit, when the whole flow-based lending came out and the term LSP was coined. Everybody was like, this is 10 years down the line, 5 years down the line. It's very, it was visionary in one respect, but it still was just on paper. Recently, the regulator RBI has recognized an LSP as a key part of lending that is happening digitally. And if you look at supply chain especially, working capital has always been an issue for SMEs, and there are players who have tried to embed some credit without any technology, which is distributors giving you their inventory on credit to retailers. That has always happened. And I think that's something nobody can take away, that's how the industry functions. What the regulator realized is that as we move digital, as transactions move digital, as penetration of UPI happens, payments move digital, logistics are also getting digitized, it's important that this credit leg or the lending leg also has a digital channel. This can only happen if you solve for all the legs. You solve for distribution, which is the job of an LSP. You solve for underwriting, which can only happen if the regulator actually comes out with guidelines in terms of what is allowed in terms of data sharing and what is not. And especially with respect to trade receivables related use cases. In the recent guidelines, the RBI has clearly called out how these use cases are impacted and how data sharing can happen between platforms or the so-called digital lending apps and the players like us who are sitting more towards creating that experience or the product layer. So there is a clear movement. It's not just some friction. So when we started, obviously there were questions around whether platforms like Walmart, for example, or giants like Reliance Jio will share their data with anybody or not. Of course, there are challenges when it comes to sharing customer data in terms of data privacy, in terms of how you store that data, consent mechanisms and all. But clearly that is something that the regulator has a view on, and it's allowed. And I have seen over time the friction to share that data has changed because underwriting cannot happen without data.
No, that's true. See, one piece is maybe on the lending side, regulator is much more clear. But if we talk about sort of your example, insurance, again, you work with a lot of distributor partners. I think one of the things, at least in my experience as an investor, that I've come across, everybody says, you know, I'm embedded, I'm distributing it via XYZ. When you go down, you see there is no product. And the founders do say that it's a pain because every customer is different. I have to underwrite every customer very differently. You know, the customer is not willing to, the distributor is not willing to share that data because it's his customer, his or her customer at the end of the day. Do you feel that, you know, that productized approach around embedded finance works, or do you feel, you know, it would still be a lot more servicey, you know, for you to scale?
No, clearly the direction that the industry is taking in the recent times is more about productization. And the reason I'm saying that is because value creation and value capture is what is going to aid the whole process. If you see today, when we are kind of connecting the distributor with our stack and infra with the insurance companies, and the end consumer via these distributors and partners are looking out for a simple unified solution. And the matter of complication that has been created over the last years on insurance is a different story. But what they're really looking out for is a solution that underwrites their risks very simplistically. Mm-hmm. If that is provided holistically via the stack that we are giving to the distributor, on the embedded side, and I'm coming back, rolling back to the most popular category of embedded insurance, which is credit protection, right? Which almost is the largest category that exists time immemorial. That rolls up, you know, takes care of almost 4 to 5 important use cases. Credit outstanding, the underlying life that is kind of there, and the assets that could be at exposure. Now this could be across rural assets, urban assets, MSME. It could be different kind of lending use case that can come through. So the value capture, when we talk about, will happen when you productize it. And this productization would not only mean insurance solution productization, but there will be other solutions like wellness and assistance services that come into play. Because the customer then is looking at comfort. I don't want to wait for an event to happen, but I want to really want to kind of use this more recurringly, and hence wellness comes into play. You know, if I'm going to fall sick, can I call local medical, call a doctor online, whatever. I'm just saying those pieces are becoming more prominent, and hence productization as a solution is becoming more dominant.
Right. No, and we talk about Indian example, and Nikhil and Anubhav, with your example, say maybe Anubhav, you are different given that some of your partners are large, and in turn their, you know, sellers or suppliers are MSME. So they have maybe their tech teams and all of that, that understands technology, that have people to go live. Nikhil, you and Suresh, you, given that, you know, you work with different set of customers. These are like truly Indian enterprise. India में लोग बोलते हैं नहीं, मेरे को product नहीं समझ में आता. I am not working in US. मेरे को solution दो. Don't talk me about API. I don't understand all of that. I want you. मैं TCS के पास जाता था. I look at you like TCS. I want you. मेरे को ये up and running करके दो. Then only I'm, you know, going to go live. What had been your personal experience? First, Nikhil, maybe then I'll come to you, Suresh.
Well, there are two sides of this equation. So on one side, going back to the analogy that I was using, that there are manufacturers and then there are distributors. I genuinely think consumers and businesses, and I want to start with this. So we all call ourselves this industry as financial services. Mm-hmm. So there is this notion of what is a product and what is a service. Is banking a product
we call it fintech,
or a service, right? I actually think that what you use as an end user is a combination of a product and a service both. If we were to strictly think about these definitions कि ये product है या service है. Like for example, if you go to a kirana shop, when you buy sugar, sugar is the product. When the guy shows you कि मेरे पास normal sugar है, I have refined sugar, that's a service, right? It's the combination of these two things that actually make the end consumer buy. I think from an end consumer's perspective, we have complicated this whole financial product ecosystem extremely.
Okay.
Like, go try buying a health insurance for yourself today, right? You will not be able to come to a decision. There will be some 10 offers that will come to you. You don't know who's going to do what, ki kya rider chal raha hai, etc., etc. Similarly, credit products. I think the future of designing products will essentially be simplification of products. जैसे कार में होता है. You have Maruti like hatchback, there is an SUV, there is an MUV. Within that, features will change. कि इसमें एक है वो है. So that personalization of financial services will happen at the feature of the product itself. For example, in the case of Anubhav, his simplicity is he has a revolving credit product. Then when he underwrites Saras, the percentage that you get is X interest rate. I will get Y and he will get Z, right? So the personalization of financial services will happen by having standardized products. And we won't create millions of products. You will have one or two products which will have a million variations. Ultimately, if you look at this, you can simplify a lot of these financial products to, like in the case of credit, there are only two types of credit products in the world.
Yeah.
You can express everything either as a revolving credit or either it's a term loan. Everything is a variation of this. So we need to go from this, hazard products that we have and simplify it. Just you think about what are the most used financial products today. Savings account, right? Everybody has a savings account. So there is no savings. So sure, there are some variations. Some say salary account, this account, that account, and all of that. But if you look at RBI's perspective, they only have two types of accounts. They say either it's a current
Savings
account or it's a savings account, right? So this simplification of product needs to happen on the user level. Now let's come to the other question that you asked around solutioning versus this. See, the fact of the matter is, all financial institutions are going through a sea change, whether we like it or not. Obviously, we want them to go through sea change. Last 30 years, my parents have been rural bankers. For the last 30 years, the way they led their lives and they did banking was always by going to the branch and delivering services and so on. Has life changed? The answer is yes. Why? Biggest lever has been the internet and digital. So all of them have to go through transitions. When you go through transitions, it's not a binary thing. Everybody, like your systems, are going to be some X. So in order to make it Z, some Y needs to be done in between. Now call it what you want. Whether it's a product or a service or a solution or whatever, it actually doesn't matter. Ultimately, the goal is to go from X to Z. Now, as technologists, some of us will say, okay, we're going to get some baseline stuff. 80% we will build as a product and 20% we will customize, right? That is the way you contextualize someone's, transformation from X to Y.
And do you see that has happened? I mean, globally, that's how it works. I mean, 80% you will have productized, 20% would still be
100%.
service.
I'll give you an example. So it's a curious thing for all of us to ask. How did UPI work? Today we have 300 plus banks on the network. Obviously, each bank has its own IT team.
Yeah.
They have their own core banking system. And in that, there are multiple core banking vendors. And in that, there will be multiple versions of core banking that they are on. Someone will be on version 11, someone will be on version 10, someone's on version 9. Then they would have chosen some other API gateway. Some will be, मैं अपना data center, इधर उधर. They would have used different hardware, some other CIO, different set of people. How does UPI work? So somebody built a product called this UPI switch, and they said, okay, this is the standardized way it will talk to NPCI. And this side of the world, there is going to be some custom work involved, because the core banking system of Axis is obviously different from core banking system of HDFC Bank. So somebody has to contextualize this to the bank that they're working with.
Sure.
So my answer is it's absolutely doable. In fact, some of the work that Anubha will be doing or they are doing at Discovery is, what do we say? We expose standardized infrastructure on the front end. We take all the complexity and we go do this wiring business. So when we are doing wiring, it's just two schools of thought. You can pick and say, okay, I'm going to put one wire each and build this complex mesh. Or you can say, I'm going to put a switch there and I'm going to put connectors there and connect each wire into it.
Yeah.
So there is this solution like product, and when you do some services on top of it, I would say product plus service is equal to solution as a formula.
Got it. And Suresh, what had been your experience, given that you work a lot more on, say, the rural side with Samunnati? And my question is more from the perspective that you deal with a segment which appears that it might be digitally non-native, the end user. And I don't know, maybe the supply chain partner that you have in between or your distributors, how digitally savvy they are. So my question really is, in terms of productizing to use this user base, what had been your experience?
Okay, so we looked at more from a solutioning point. Because that's a thing that we need to look at in the segment. They say, I got a problem or I got a need. How we are going to solve it? Now, that responsibility has to be taken, right? How you said, whether I want to build a switch or I want to build the wire. So at times we have to take the both, right? So what we have looked at is that first have the empathy, because one thing that we all need to look at is that that segment requires a lot more empathy, because there is decades of negligence, decades of, what we say, non-connection. So that's why they have a parallel ecosystem. We can call any network, but they have that network, what we call the social capital. Now, we have the trade capital, that's what we are talking about, whereas our approach has been the social capital. What do I mean by that? Today, in UPI, you can authenticate using a authentication mechanism. It doesn't check anything as long as the two originator and the subscriber, they talk to each other, authenticate, it works. But if you go to the rural, the first thing they will look at is that, oh, Saras, who is Saras? Oh, unka beta. Oh, I know him. Okay, we can give it. No, don't give it to Suresh. Now, there is already a validation mechanism that works for historical reasons, right? So therefore, the way that we wanted to leverage is that how do I build that, the social capital? And the second thing is that since a lot of digitization has to happen in the segment, we have taken an assisted journeys. Therefore, what we done is that we kind of looked at our entire model has been working through the collectives, what we call now the LSP is equivalent to the borrower's agent. So we use the collectives as the via media. So therefore, by touching the collective, you kind of look at, in those days, you put a router and then go into the remote places, we are doing it. That's the first thing. The second thing is that the solution can be given in any form. Not necessarily everything has to be through lending. It could be facilitation as well, right? Because what they need is a lifeline. Either I need an oxygen cylinder or the air is pure. So sometimes we have to put the cylinders. So we put the cylinders where they need cylinders. But then we kind of expose them to the market to play, and therefore we come and do the intermediation and the facilitation. Now, it's like this, right? We go to a theater or we go to a restaurant. Let's say, for example, they give you a card, use this card, you buy wherever, you come and settle it. Or you say, load the card and spend the money. The same process, the card is the same. Whether I want to load the money and ask him to spend it, or I will give him that credit and then let him come and settle it. So the way we looked at is that the structure is that we are looking at an NBFC, a lending arm, then also an intermediary agency where we bring all the ecosystem players there. Say for example, an input provider comes in and says, I want to give the seeds and the fertilizers to the farmers with the clear understanding that after 15 days or 20 days or after a month, I'm going to collect it. So here the FPO stands as a guarantor, or we kind of facilitate that by saying that there is going to be a buyer. So now by bringing the ecosystem players, then what will happen, you kind of strengthen the framework. Because one thing that we all need to keep in mind is that end of the day, wherever we lend money, we need to recover.
Yeah.
Right? So that's why insurance comes as one mitigant, but the risk mitigants has to be factored in. So as long as we kind of bring the risk mitigation, and today most of us in this room, we get at least on an average 5-6 calls from various banks offering personal loan credit card without even we ask. But we know the farmers or the rural, they have cows, they have land, they do this activity for the last 30 years. But even today if you go, they need a collateral to deposit. Why? I mean, we all need to look at it. It's not that we don't trust them. The question is that their ability to pay on time. And therefore, if by bringing that entire ecosystem, the embedded finance also look at the price realization, then the efficiency as well as that enablement increases. And therefore, that is what will really take this into a, what I call a massive success, moving away from cities and towns into the village. And we all look at, I mean, just a recent RBI report that says, despite all this penetration, still 60% of the rural population do not have access to institutional credit.
Mm-hmm.
That's a very big number.
Yeah.
The second problem that we all need to look at is that out of 100 loans that we apply, 40 loan applications are getting rejected because of some issue or the other.
Mm-hmm.
Now, when we look at it, what is it then I can embed to make it seamless? So, one is that work with them, enhance that entire backward integration of data, that's one. Second is that bring the products, and because the product personalization is another challenge. We now cookie cut, an acre of wheat farmer will get 40,000 rupees as the loan. But he would do intercropping, therefore the loan requirements are different. And why should I limit a crop? Why can't I say that I will give you 1 lakh, you try these 3 things? So I think we need to move into the direction. And good part is that there are a lot of the private sector, the fintechs are coming into that space, but it has to be done in a much more orchestrated manner. It cannot be a sporadic. That's what we see on the ground.
Got it. No, that's interesting. And Anubhav, do you see, I mean, you touched upon, say, digital footprint. Particularly, you have to create those digital footprint. Predominantly, I think, whatever has happened with Reliance Jio, there is a lot more sort of acceptance of, say, technology. But in your segment, what do you do? What do you see? I mean, MSMEs and all, do you see, data capturing is easier? Do you face difficulty on that side?
So, I think for MSME especially, while low-cost internet and, smartphone penetration going up, there is clearly adoption towards digital technologies. But since it's more about, any financial product is more about building trust, there is still some inertia. And there is always, like Suresh mentioned, some assisted journey that happens. Especially in our case, because the focus is on the micro and the long tail of SMEs. If you start going into the long tail SMEs of the country, you would see that the interface may be a smartphone, but the closure of the transaction still happens offline, because they really want to experience through the voice of a human that are they actually talking to some entity that exists, or is it magic that's happening? So they'll always complete almost 9 out of 10 steps, but to get to that closure, you'll have to make a call, you'll have to visit them, right? It's not that the guy is not equipped to complete those 10 steps. It's just that it brings that sense of trust for that MSME, that this is something that's, because for them all that matters is, this is my core bread and butter. I know only one thing, which is to run a shop or which is to do this. Am I getting into something which will land me in trouble? Right? Especially when it comes to lending. Because of practices that have happened in the past, people do fear that what am I really signing up for? Is there a fine print? Like a loan document runs into multiple pages. Nobody knows what every term means. So that trust building has to happen. And I think even though contextualization is important, like for example, if you try to give a working capital credit right at the time when a retailer distributor transaction is happening, there cannot be anything better than that, because that's 90% of the working capital the guy needs. Still, when you embed credit, there has to be a sense of trust that needs to be built. Once the trust is built, I think then the repeat, the loyalty is much higher.
Got it.
Some of these use cases.
Interesting. So maybe I think let's talk about, we've barely 20 minutes left. Maybe I would want you to talk about a little bit about some of the business models that you've seen, and particularly the way one can look at this space is, an NBFC, which is, or bank, which is an asset owner, the distributor really, who's distributing at the end, and then the API layer. So sort of, and there are a lot of entrepreneurs who've started. Where do you see value capture happens? Aapne bana diya, but malai koi aur kha raha hai. And Anubhav, I was speaking to you, today you are API provider, but you do want to become an NBFC at some point of time. So sort of first with you, where do you see value capture happens really in this business?
Interesting question. And as I said, the Malai is now kind of flowing through the entire value chain. It needs to get tilted to a particular angle. But coming back to the answer, the value capture originally was happening obviously at the manufacturing side, originally. Infra created that facilitation to make it more experientially better, more ease of use, everything that has happened due to the infra that's helped make the whole playing field even, if you may. And when you come to the user and the consumer, that's where basically the main experience hits or experience is felt by the end users and the consumers who are using this technology. They don't care where this, the overall solution, whether it's the raw material that's flowing through this infra or the infra that has been created. For them, it's the agnostic.
Yeah.
So the point was that who's thinking on behalf and for the end user, and are they doing that job efficiently? So maybe over the years, what happened was because it was a piecemeal process of putting all these things together, the evolution caused or created a rail or a pipeline or a solution which definitely benefited the end consumer and the distributor, but that wasn't perfect. In that process, what has happened is, for some use cases, some segments, like insurance, players have been able to, like it might be an intermediary or the infra provider themselves, who've been able to kind of foresee that there is a possibility of value capture, value creation by creating a holistic solution along with the infra and give it to the end consumer.
So essentially, do you feel one would do that because you feel the value capture is happening more on the asset owner side?
I mean, they do definitely play a big role, right? So
Nikhil is smiling. I think maybe I'll come back to you. I mean, do you run Penny's business, Nikhil? In that case, would you play on volume or?
No, look, let's be honest, right? So financial institutions have always had arbitrage because of licensing.
Yeah, that's true.
So, and licensing was what makes a manufacturer in the world that we are living in. And therefore, that arbitrage obviously gave them most margins. Though the thing that's changing, to Saurabh's point, is that, see, in the physical world, when this whole FMCG thing played out, people were limited by their ability to be physically available all over the country. So you had real physical constraints. So that's why you needed 1 million Kirana shops, right? Or tens of millions to service people when there was physical goods. when this financial services is going digital, and by the way, it's not gone digital, right? To Suresh's point, I think we're just at the beginning of this change. The next 10, 15 years is where this change will actually happen. That's why India's decade and all of that stuff. So we are just at the beginning of this. The thing though in the digital world is because of the internet, there is no physical constraint. So the leverage moves towards this distributor or so-called retailer, right?
No, but I'll argue that, Nikhil. And say Saurabh works in insurance, and when I look at the distributor's margin there, I'm like, why the hell are they fleecing me? Bloody, I'm paying 30,000 premium. It should 18,000 of that goes to the distributor. But when I look at lending side, maybe as a DSA, your margin would be very minuscule, right?
1 to 2%, like
right?
highest in the.
And both of these are regulated business by the way, right? So I don't know why it happens, but insurance, how distributors had been able to capture that well, whereas in lending or some other financial products, we don't see that in savings or lending or broking for that matter.
No, I'll tell you why it happens. So look, generally the power law of how money gets this thing is on the work done principle. जो कितना काम करते हैं उसको इतना मिलना चाहिए, right? So if you look at the manufacturer,
So maybe insurance is a hard sell, and that's why distributor takes that money.
no, like manufacturer takes risk, so he has to be adequately paid for making that happen. The distributor has the cost of servicing the customer. There is SCAG, there is maintenance of that customer, support, etc. So they need to be paid for that. Then the infrastructure providers who are facilitating this need to be provided. If you ask me honestly, if you look at the margin structures, manufacturer makes the most, next comes distributor, next come the infrastructure guys. So then the question is, how does this scale? So the manufacturer has to manufacture good products and scale. Distributor has to bring as many products as possible and sell. And infrastructure companies have to do this at scale. That's the business model.
Right. And on that, particularly one of the things that goes in everybody's mind is disintermediation, right? Anubhav, you are maybe today working with Walmart or Zomato, you're lending to their suppliers. Does this thought cross your mind that the moment I scale, Zomato would put up an NBFC and they'll start lending, or Walmart would put up an NBFC and start lending? And how do you see you'll be able to grow in that scenario?
Sure. So I think the answer is yes and no. Technically, yes. But practically, it's not that easy. Like all of us spoke about, it's not just about one part of the life cycle. It's not just a distribution game, whether it's insurance, whether it's lending, payments. And it's not just about who takes the risk. It's not only underwriting. If it was all about underwriting, then banks should have penetrated long back, right? It's also about collections. So to build all that infrastructure, I think is not something that is the core strength of everybody. And that is where, the crux of today's topic actually lies. Why embedded finance or embedded lending or embedded insurance exists is because there is one entity whose strength lies in distributing a non-financial product probably to a large set of customers and building trust with them. Building trust to a level that the same customer is ready to share more data or information with that same platform or entity. And in the context of his relationship, and that's very important, because if it's out of context, then it will fail. In the context of that relationship, ready to pay you a premium in some cases for a financial product. Let's take a simple example. And this happened like long back. I was going from Kormangala to Bangalore airport, booking an Ola, message pops up, 49 rupees, and missed flight insurance. So in context, I was like, I'll grab it. I almost knew I'm going to miss my flight today, right? if 49 rupees is what it takes for me to get my flight cost back, why would I not do that? And that's what makes it successful.
No, it
ultimately.
does, but do you feel that Ola tomorrow would start offering insurance? I mean, they'll maybe acquire some insurance companies, start offering that. So where would your business model lie in that case,
So
right?
not everybody would be able to do that. Of course, there will be players who would like to own every single point of a customer life cycle, and we do have examples of that. But I don't think everybody is going to be able to do that. So there will be still place for people who excel in underwriting versus people who excel in creating the right pipes and the wires, and people who create only the switch. I think it's not going to be completely disintermediated. In fact, as regulation comes deeper, it will be even hard to disintermediate, is what I believe.
Got it. Okay. Interesting. I think India honestly has been very different in terms of the infrastructure we had around financial service. That's a debatable topic. On one hand, it leads to inclusion. As an investor, sometimes you also think that can you create a winner-take-all model in India? Given that there is digital public goods, you can't maybe make a Stripe or Plaid in India because हमने problem solve कर दिया है. I mean, unlike US in some of these markets. So Suresh, and what's your sense, given that you look at few of the elements of India stack as well, Nikhil, you were extensively on that side. Would our embedded finance journey be very different from the West? Do you see the digital public goods that exist, the way we have to build products, the way we have to distribute, the kind of businesses would be very different than what you've seen in the West. So maybe Suresh, you would want to touch upon that, and then Nikhil, I'll come to you.
Okay. See, in some areas we are already leading the way. So we need to kind of break it into two parts. What is going to be the unique or the differentiation? See, there is a lot of convergence happening, right? The way the behavioral pattern, the purchase patterns, everything, right? Today, look at all of us, the way that we dress up, the way that we eat, everything has become global. There is no differentiation on that, right? I think what's going to happen is that the standardization is what is going to become the real global. We look at one unique dimension that especially that India which is going to carry is that our diversity. That is bound to happen. It be our language, the culture, the preferences. So that way what we are now creating is nothing but a replica of the world. That's one part. The second thing is that the great example sometime back we spoke about, right? Nandan was also talking that India, Singapore, the UPI payment and the pay now. Now what's happening is that we are not saying are they the same. As long as both are able to connect, talk to each other, right? The same way, if we create the product and structures, in fact we see that there are a lot of similarities between our rural population with the African segment, right? Some of the Asia Pacific. So in that way we are going to create products which are going to be more universal in nature, but there will be some localization or something like that we need to personalize. Any of that is going to happen in our own product structures that we are talking about. So I don't think so there's going to be far much of difference, but I think where it's going to be really unique in the way which the regulations are going to be there, how much the local regulators, the government want to kind of have control, how much of the data interface that is going to happen. I think those are the areas that we need to look at. Last but not the least, let's also keep thinking about how much ever we exposure, it also brings its own vulnerabilities, the risks that are coming in. So are we ready to prepare for that? I think that is where this whole thing is going to change in my view.
Got it. And Nikhil, what's your sense? I mean, we'll keep it short because we'll have to open for Q&A as well, but what's your sense?
First of all, I think the US and India has nothing in common except for Indians who are in the US.
That's true.
So, because look, see, this is actually not rocket science, okay? Because the US is an extremely highly credit penetrated market. They've hit their peak, right? So if you look at history, everyone's prediction is India's numbers are like this because we are going to hit our peak in the next 20, 30 years.
Yeah.
So a lot of what's been done in India is in our context. There are only 30 million people in India who are actually earning like a middle class person in the US. And rest of the entire country is poor, whether we like it or not. All of this shebang that we are doing is to uplift those people. So that why is credit important? So that we give them credit, people aspire more, and therefore this country's economy grows, right? That's the whole, like the circle that we're trying to build. So I think the reason why we will not be US is as simple as the answer that we are not US. We want
That's
to
true.
be US.
Yeah, no, of course.
So this whole infrastructure business that we are in it took them 200, 300 years to do this. How do we get there in the next 20, 30 years? And then there's one specific point that I want to make, that US is matured in its, or any other Western market is matured in its democracy, particularly in the US, that most innovation is market-led. If you look at the regulatory things and what you can do and so on, it's all market-defined. The difference in India is a regulation-led innovation market, where the regulators are basically opening up and enabling, whether it's through digital public infrastructure or, like as Anubhav was talking about, digital lending guidelines. There is no mention of any of this in the US. They are super highly, extremely credit penetrated. Everyone has 2-3 credit cards. The entire country is in debt. And fortunately or unfortunately, even our goal is to reach there, because that's what the world defines as being a superpower, right? So I think, like, given our context, all of these things that's happening is very different because of where we are economically. And maybe 30 years later, when we become one of the major superpowers, maybe number 1, number 2, when we take over China, then, probably a Stripe or Plaid or, things like that will happen.
Awesome. Great. So Saurabh, maybe I'll, just close it with you. Given that you are in insurance, I think we have a lot more, I would say, all the regulators are active, is what I'll say. But I see RBI is much more active in terms of defining. IRDA, you work on the insurance side. So what is your one wish from a regulatory standpoint that will actually help accelerate, this adoption of, say, insurance in India? What would be that one wish from your side?
I think both the regulators work with the same ministry, and if they start working in tandem, that would be a very good move to start with, right? So what I mean by that is big brother, small brother follow each other, and ensure that, remove that friction.
And where do you see that? Why do you say that? Do you see any specific points of friction?
Ideally around, basically, if you see the margins, the distribution caps that are there in the insurance side. Plus, we've got, at the same time, we're talking about, increasing penetration by getting more licenses being rolled out for new insurance companies coming in the way. And the RBI obviously is keen to ensure that the banks focus mainly on banking, not on insurance.
Yeah.
Right? So it's a little bit of a, they probably get into one room and figure it out.
Got it. No, that's interesting. So I'll just stop at that. We have a little bit over 3 minutes left. I'll just open up for a couple of questions from the audience. So please raise your hand. Yes, ma'am. And who's next? Please raise your hand now. Go ahead.
What was missing from the conversation was anything to do with investing and savings. So any thoughts on, did you guys consider that it's part of your business, and what,
Sure.
what made you do
Maybe
that?
I think, Nikhil, you are best placed out of remotely. I see you touch upon savings a bit.
Yeah, there are just 2 points of view. One point of view is a little extreme in the sense that there actually isn't enough money with people to save. The whole reason why the whole credit story, especially if you look at MSMEs, they're basically trying to make day-to-day work by borrowing, and and it reflects the way current accounts work. It's supposed to be a zero balance account because money comes and money goes. That's one point of view. But however, it's time and again proven that savings is the right behavior for people to build wealth. And there's a lot of amazing things have actually happened in the last 5-10 years. You're going to see Nitin come and speak next. Generally, if you look at innovation cycles, it mostly always starts with the richest, and then it then trickles down. The moment it works for people at the top, like Zerodha, one of their biggest success has been they've used India Stack and they've reduced the cost of onboarding, and therefore they've been able to increase their customer base. We've seen that happen in multiple things. For example, we happened to work on building an FD product. Unfortunately, due to regulatory things, it didn't go well, but we actually figured that it's actually, you can actually open an FD for 500 rupees if you really want to, and it can still be profitable for a bank and for the customer as well. So the digital infrastructure that allows micro savings to happen, because your KYC is come down to like around 5 to 10 rupees. Therefore, and the cost of collection on UPI is zero. So one of the things that we did with our FD product was you fund it through UPI, and because the cost of UPI is zero for a merchant, like in this case being the bank, so their cost was kind of limited around 10 rupees, right? So you're now able to build these sachet-sized savings products. And I think just like how there is credit, like I was saying, I genuinely think there are just two types of savings product. One is again like a term-based savings product, like a fixed deposit, and another one which is recurring deposit. Like you'll see there are a bunch of startup out there who are showcasing, like for example, Gullak, which is enabling, sachet-size savings into gold as the asset class, which is nothing but a gold RD if you think about it. So I think the rise of these sachet-size savings product will happen. In fact, there are other second-order effects of this. For example, on BBPS today, the Bharat Bill Payment System, one of the categories that's been going has been loan collections. But alongside, RD has been opened up as a category. So what that means is potentially a user who has an India Post RD, right, can actually go to PhonePe or Google Pay and say, okay, I want to save 10 rupees today. I want to save 50 rupees tomorrow. I want to save 100 rupees. This is already in progress as we speak. And I think in the next 5 to 10 years, savings behavior will change.
So, no, it would change. And just to add to that, I think the important aspect in saving is the trust factor as well, unlike, say, lending in some of these products, because you have to build and earn that trust. Somebody is giving his or her hard-earned money to you. I mean, we've had sad examples in the past, right? I mean, Sahara scam and bunch of other situations. That building that trust factor for savings to take off is also very critical. So that's also one of the...
Even Zerodha's 30 or 40% of their cash balances are in FD.
Yeah.
So, and Nitin will come and say probably that FD has outperformed the markets in the last 1.5 years. So going back to these simple instruments that have existed, around 7.5%, and I think FDs and RDs there is going to be a graduation step. You'll start with bank-based products like FD and RD, then start SIPs on mutual fund, and then, you will go to stocks.
That's true. And just to end, I think we're out of time. Everybody's waiting for next session. One other thing just want to add to that is, as a business model in savings, what we've seen as investors, the margins are pretty thin. Say if we talk about lending, you work with a spread of whatever 12, 13%. 5-6% is your OpEx, you have room around NPS, right? And you still have decent margin to scale up. Savings, typically an AUM business, long gestation period, margins are pretty thin. So I think that's also one of the challenges that I think people will have to solve for. So we'll end it here. I'm sure everybody is waiting for the next session. Thank you, everybody. Really kind of you to join us and share your insights. I hope we had more time, but so be it. And thank you, audience, for joining us. You're waiting for the next session. So do enjoy and have a great time. Thank you.